We're half an hour away from the open in Hong Kong, Shenzhen, Shanghai. You're watching The China Show. I'm Annabelle Drewlers with David Ingles.
Good morning. Let's get to your top stories today. Markets on edge as President Trump says he will decide on a possible Iran strike within 2 weeks, extending the uncertainty over whether the U.S. will back Israel's military action.
China's president calls for a ceasefire after criticizing Israel, but there's little sign Xi Jinping is ready to provide weapons or other direct support to Tehran.
Plus, we hear exclusively from the IMAX China CEO about their aggressive expansion plans in the world's second biggest movie market.
Well, Dave, starting the show this morning with some breaking news. We just had the LPR decisions coming out and actually unchanged, and that was really what we had been expecting here because we had that 10 basis point reduction in May. That did track a cut by the PBOC. So today the expectation was we wouldn't see any changes. So the 1 year LPR, that's the reference rate for corporate loans, staying at 3%. The 5 year LPR as well, that's the benchmark for mortgage loans, holding at 3.5%. I mean, you've got, this narrow net interest margins already, so lenders are going to have little appetite for lowering their lending rates further if you don't have that PBOC easing in place. But you can see here, not too much market reaction really to this.
Yeah, largely expected going into, of course, this specific release of that monthly data set. But going into the open today, perhaps also the lack of clarity, the lack of conviction either side. Perhaps the incentive is to remove a little bit more risk going into a weekend, of course, given what's taken place so far. Now, Asia is up because of this. The rest of what we're seeing across these markets is either sideways to slightly lower, like the TAIEX index coming into the open today. S&P futures, though, still low, but coming off lows of today, I think, is the more nuanced take there. Let's have a look at FX markets. So that was the big one, in fact, overnight, with dollar weakness coming through when the headline dropped, when the White House talked about the 2-week window in terms of deciding whether or not the U.S. will be, I guess in some ways, participating in Iran. So we're still looking at dollar weakness. In fact, hence why we're looking at euro dollar back above 115 right now, as you can see on your screens. What is it catching a bid, though? It is today to some extent, but certainly not part of the move in the last 10 hours or so, has really been the Japanese currency, and to a lesser extent what you're seeing here in the Asia Pacific as far as FX goes. 10-year yield. Bottom of your screen is 4.39%. Let's call it even here. Right. Energy markets going into today. So we are slightly, I think we're up still for the week, up, in fact, for a third week. We're coming off a little bit, although you're getting a premium coming through. And the premium that people are attaching now to what's taking place is about 8 to 10 U.S. dollars a barrel. Shanghai crude coming in line 3%. Asia Pacific stocks are snapping, as I speak, snapping a 3-day loss as far as that specific benchmark is concerned. The approach to the open today, futures, you have the Hong Kong dollar, which is coming back a little bit from the, I spoke too soon, okay, well, 784.99 right now. 785, of course, is that level, line in the sand, hard line in the sand. And we're looking at 718.40 ahead of the fix today, which really has been, Bell, on the stronger side of things as authorities look to, I guess, in some ways, anchor the Chinese currency. Bell.
Yeah, it's really that de-dollarization trend in the questions as well. But have we hit a peak dollar? And we've got Frank Benzimra actually coming up with a view on that in a few minutes from now. But as you said, it's really that focus on what's happening in the Middle East. And Israeli officials are saying that they can penetrate the uranium enrichment hall at Iran's Fordo nuclear site without U.S. assistance. This comes as President Trump says he will decide within 2 weeks whether to launch a military strike on the Islamic Republic.
I have a message directly from the president, and I quote, "Based on the fact that there's a substantial chance of negotiations that may or may not take place with Iran in the near future, I will make my decision whether or not to go within the next 2 weeks."
Let's get more on this now. Bring in our desk editor, Jill Deesis. Also here is our China correspondent, Min Lo, joining us this morning. And Jill, we can start with you today. This 2-week window, I mean, what sort of significance do we attach to that sort of deadline, and what do we expect to happen realistically in the interim period?
Right. Well, Belle, I think when it comes to Trump, the big factor that you have to keep in mind here is that 2 weeks is it's kind of like his favorite unit of time, really. I mean, you know, whether that's a negotiation tactic, whether that's something that actually gives us a more definitive deadline, I think is you know, a little unclear here. But I mean, this is something that he fell back on repeatedly during his first term in office, whether it be something about, you know, tax policy or some other sort of you know, political wrangling that he was coming up, just kind of throwing out that deadline. So I'd look at that as being a little bit soft here. But I think what's really significant here is that this does indicate it kind of seems like Trump himself is going a little bit back and forth on whether you know, he thinks the U.S. military should get directly involved. I mean, just about a week ago or so, you know, he was stressing that idea of you know, bringing Iran back to the negotiation table, you know, trying to get them to commit to stopping from developing any kind of nuclear weapon. That really shifted over the last several days when we saw him sort of leaning a little bit more into you know, saying to Netanyahu that he was supporting Israel. Now I think we're sort of back on this idea that maybe there is room for negotiations. So if anything, it just kind of gives us that you know, sort of wall of uncertainty. I mean, we were hearing just yesterday that there was this idea that the U.S. could get involved militarily you know, as soon as this weekend. Now we're building a little bit more buffer there, but I think ultimately it's just telling you that this is still a very live situation, still a lot of factors here, and that ultimately you know, the president doesn't really seem to have decided exactly how he wants Washington to move forward.
Right, and you're right. It's not as if we can table the story for now and come back in 2 weeks. What do you need we should be watching out for this weekend?
Well, really, I think that, you know, at this point, I wouldn't look at this as you just said, David, I wouldn't look at this as a specific deadline 2 weeks in the future. I think it just does mean that anything could potentially be happening this weekend. I mean, the Wall Street Journal reported a couple of days ago that Trump has sort of, in effect, signed off on some kind of a plan of attack, hasn't given the final order for that, but that there is that idea that the U.S. is at least, you know, obviously drafting potential plans for U.S. involvement. I mean, you know, we were talking about there's some debate among experts over whether Israel actually has enough military firepower itself to, you know, attack some of these nuclear facilities, you know, in the way that maybe the U.S. would. I think, you know, again, sort of a situation that's up for debate for experts, but it does kind of indicate, I think, here that, you know, you can't completely rule out the idea of more fulsome U.S. military involvement, and it's something that you're going to have to look out for going into the next few days.
But to your point around this sort of debate that experts are having as to whether Israel has the capabilities to act on its own, they're certainly signaling that that's their intention, regardless of what the White House does as well.
Yes, definitely, Belle. So at this point, you know, there's a camp of experts that would say that Israel, without things like B-2 fighter jets or, you know, more heavy bombs, that they wouldn't be able to, you know, have that impact that the U.S. military would. But there's, again, another camp of experts, and I think, you know, Israel itself really, you know, kind of indicating that maybe it does, whether that be through sort of commando raids, whether that be through more, you know, high-risk ground incursions. Maybe there's some options there. But certainly, I think what you've seen over the past week is Israel, Netanyahu kind of, you know, being pretty brazen and very confident with the level of attacks that they've been instituting on Iran. Certainly, if they're sort of projecting that, it's another thing that I don't think that you can really rule out is whether Israel just goes ahead and tries to accomplish some of their goals themselves.
Min, I'll bring you in on the China angle here. Has China responded? What's China's role in all this?
Yeah, China has been quick to condemn Israel's attack and has said that it would offer to mediate this conflict, but it's largely seen as not having enough sway, especially on Israel, right? Given China's response to the Israel-Palestine conflict, Israel likely wouldn't want to accept China as the mediator here. And China likely will also not want to extend any resources in a long-drawn war so far away from the country to be entangled in something that is not involved in, because China has a long policy of non-interference, right? And it also risks escalating ties, tensions with the U.S., knowing that Israel has the Trump administration's backing, and tilting this playing field towards Iran's favor could risk escalating tensions with the U.S., and that's something China will want to avoid. And I think its key priority now is ensuring its energy security.
Yeah, but on that topic of energy security, I mean, they have the capability, even though they have been a big importer of Iranian crude, they can replace that supply relatively easily from other crude exporting countries. What's that relationship looking like between Beijing and Tehran, and why is it different to the relationship we see between Beijing and Moscow, for instance, and their sort of support that we see with the war in Ukraine?
Yeah, in some ways it is similar because China, also with the war in Ukraine, China has provided a lot of political, diplomatic support to President Putin, but China has been very careful about not providing weapons that could attract sanctions. And I think with Iran as well, they are very careful about not providing material support. So far, there has been a lot of rhetorical support, and China has proposed this 4-point peace proposal calling for ceasefire to avoid civilian harm and calling for major powers with significant influence over the parties of the conflict. Primarily, they didn't name the U.S., but it's a veiled reference to the U.S. to do more. But I think China still wants to be very careful. As I said, non-interference is a long principle. That's something China sticks by. It's something China has criticized the U.S. for being involved in this protracted war. And I think, as you said, China can get crude oil from elsewhere, and that also speaks to China and Russia's relations because the two presidents, Putin and Xi, spoke this week. It would likely create new impetus for both sides to speed up progress on that new Power of Siberia 2 pipeline to increase gas imports from Russia as well.
Right, team, thank you so much. Min Lo. On the China angle, Jill Deesis, of course, they're on the latest, or at least a lack of clarity on the latest, as far as the White House is concerned. Right. Now, where this comes together for markets, right, and the iteration of this is really where oil prices go and the premium people are attaching now to the uncertainty out there. So there's the uncertainty, there's backwardation. We have a couple of stories out, which we'll talk about in a moment here in terms of what the implications are, right? So we're getting, when you look at some satellite data, Iran seems to be pushing out more output coming through. When you look at some of the data across the Strait of Hormuz, for example, it doesn't seem to be that there's a lot of traffic going through. And the third thing I want to point out is you're getting shipping prices. Our folks at Bloomberg Intelligence do think that we will see at least, well, we don't know if it's transitory or not, a pickup in shipping prices because of everything that's taking place in that part of the world. Let's bring in Nicholas Lua to talk us through here the implications on energy markets. He's in Singapore for us. Nicholas, let's talk about the oil exports, because we have a piece on that. If you could just outline what we're seeing exactly there. How are exports from Iran faring amidst what's going on there?
So the short version, David, is Iran is actually rushing to export oil out of its critical export terminal, Karg Island. If you look at satellite images, what we see is that these storage tanks have filled up significantly since the attacks have started. In fact, it's an increase. We've actually seen oil exports out of Iran up 44%. And the reason these tanks are full is not because people are not coming, but because Iran is trying to push those cargoes out as fast as possible. We also see from satellite imagery that tankers are actually avoiding the straits. And what they're doing instead is they're holding off until it's time for them to load their cargoes. They rush into Karg, they pick up those cargoes, and then they rush out ASAP. And this has been a pattern that's been going on as they try to make sure they get their oil out in the risk of, let's say, some kind of escalation happening.
Yeah, I'm glad you brought that up. In fact, just for our clients, just a plug here, of course, the Hormuz tracker that we have, to your point there, Nicholas, the fewer ships are entering this choke point as we speak. Now, that seems to be the worst case scenario if we do get a blockage here. What would be plan B, plan C's, plan D's in the event that we do get this the Strait block? You know, what are neighboring buyers like India, for example, planning to do in that event?
So we've actually spoken to India's oil minister recently, and what he said is that India is planning to import its crude from elsewhere should there be issues with the Straits of Hormuz. Now, bear in mind that the Straits, according to the oil minister, supplies India with more than a quarter of its crude. So that's a significant amount of oil to replace. And along with that, the minister has also said that India's planning to actually reduce its exports of oil products, so fuels like diesel and gasoline, and keep what it has for domestic consumption. So that's sort of the pattern. So people are on edge and making plans should the escalation we are all looking at actually come to pass.
Yeah, you mentioned the surge that we're seeing in diesel prices. Just dig into that a little bit more, because it's certainly, we have seen the rise off the back of what's happening in the Middle East. But where does the market go exactly from here, and what's the outlook?
So I think it's important to flag that diesel right now is really strong. It's stronger than it has been in over a year. If you look at ICE gas oil, the premium of diesel to the benchmark in Europe. It's actually at the highest it's been in over a year. In fact, we're seeing the same thing for the Asian counterpart for diesel. And the reason why that is because the Persian Gulf actually is home to a lot of major oil refineries that export diesel. In fact, in 2024, 850,000 barrels a day of diesel passed through those straits. And so people are worried about crimping supply. And as a result, that's why prices are up. Now, this is all happening. This crisis is happening at a time when diesel markets are already under pressure. So if you look at US, diesel supplies are at seasonal lows. And if you look at Europe, Europe's been dealing with a couple of refinery outages that are crimping available supply. So everyone's on edge, and I think we're seeing that reflected in the direction of the diesel market.
Yeah, as you said, I mean, the conflict really getting underway when diesel markets were already looking very tight globally. But great reporting there. That was our Bloomberg oil reporter, Nicholas Luo, joining us from Singapore. And counting down, of course, the open of trade in Shanghai, Shenzhen, Hong Kong. We just got the Yuan reference rate coming out as well, 7.1695 per US dollar. The estimate had been for 7.1826. But more analysis on that just ahead. You're watching The China Show. Happy Friday. Well, you're watching The China Show. We just got that Yuan fix going into the ad break. Recapping it here, another strong fix, 7.1695. The estimate had been for 7.1826. But let's get the context on that now. Bring in our MLive strategist, Mark Cranfield. And Mark, you just told me in the ad break there that it was a pretty punchy one. So what's standing out to you about that today?
Yeah, it's the first time the fixing's been below 7.17 since Liberation Day. So all that time, everything has been erased, and all the gains for dollar yuan more than erased, actually. It's actually the lowest fixing sometime in March. So pretty aggressive in the context of a fairly uncertain world. You've been talking so much about people going into the weekend, oil prices are still pretty firm, people really on edge. And here we have the Chinese central bank very confident in the direction of its currency, giving traders a clear sign here that it doesn't fear anything to do with its own currency, the yuan. It thinks it's going to get a little bit stronger. It's interesting because now, if you look at the offshore rate, the dollar against the offshore yuan, it's actually trading quite a bit lower than where the onshore closed last night. Now, sometimes when onshore markets get trading, which they will do in about 10 minutes in China, the central bank will push back slightly. They won't allow the onshore yuan to gather at the same pace as the offshore currency. Let's see if they do that, because that would show traders that they want only moderate gains. But if they don't, it's a very clear signal across Asian currencies that China is confident and that all Asian currencies here should have a pretty decent tailwind, regardless of what happens with major currencies. So we're getting a bit of a trend here where Asia is starting to outperform other parts of the world in terms of currencies.
Mark, normally when we get some anchoring on the Chinese currency, we do get, most times, not all the time, most times we get an anchoring across EM assets. That doesn't seem to be happening, though, at this point in time. What do we put that down to?
I think that probably would take a little bit longer because of the element of US bonds involved there. So the emerging market space, a big element of that is how they price against US treasuries. And for now, you've still got a lot of uncertainty and volatility in the treasury curve. So until you get good stability there, it's harder to price emerging market bonds, especially. The whole fixed income world needs some stability in US rates before they can decide which are the right spreads and how to adjust position accordingly to that. We're in a transition phase here where other yield curves, like the German yield curve, are becoming more important, even the Chinese curve to some extent for Asia. But it hasn't fully bedded down yet. We're still moving. The currency market is a bit cleaner. Macro traders will typically go there first to express their views, then they'll migrate to equities and bonds, and then eventually to commodities as well. So we're working through that, and it will take a bit longer, particularly when you've got this situation where the Federal Reserve, they're pricing for more interest rate cuts through their dot plots, but the messaging is not very convincing at all. It actually looks as though they want to be on hold because they fear inflation. That's not an easy message for other central banks around the world to digest. You saw that even Taiwan yesterday, they held rates unchanged, even though the Taiwanese currency has been outperforming everybody in Asia. So it's quite a tricky time for Asian central bankers to set their path, and that's making it more difficult for EM investors as well.
Mark, thank you. Mark Cranfield there, the setup for the Friday session out of Singapore for us. In fact, just on that very note here, we're up 0.25% going into the open today. That's the Hang Seng Index specifically, but still, despite even at these levels, we're still on track for a weekly loss across most of the major benchmarks here in Hong Kong. A preview of the Friday session is just ahead. This is the China Show. Good morning.
You're watching the China Show this morning, and Dave, this is really big news because the Labubu craze has just been so unstoppable for so long now. But maybe it's got an obstacle that's really coming up in its path, because there's some commentary that's just come out this morning from the People's Daily, so the flagship newspaper in mainland China, and they're saying that China needs to refine regulations for blind cards and mystery boxes, because the concern is that you could be essentially leading minors to become addicted to purchasing these boxes. I mean, I don't think it's just minors that are at risk here of getting addicted to Labubu. We just had a Labubu doll fetching $150,000 at auction a few days ago.
Yeah.
But you're seeing that instant market reaction there.
And I think it's one of the first times, to the point Belle was making, right? There's a craze around, of course, the product. There's been a craze around the stock. I think it was the most, or if not one of the top three most traded stocks this week or yesterday. And also, it's the first time that I think the stock is actually trading below the 12-month target price of the market. So I guess, this time, the next hour, we actually have a larger segment on this. We'll talk more about the pros, the bullish case, and the bearish case for the stock itself. But this really adds a lot more, a thicker plot line going into that. We're down 6% in the early goings. New World Development is also one stock that we're tracking.
Yes, this is another stock that's, of course, faced a lot of pressure, and there's been a lot of concerns around the company's capability to repay some massive loans that are due, but we're hearing that they are near an $11 billion refinancing deal for that debt, and so that really would push back these loan commitments into next year and also into 2028 as well. So you are seeing that sort of relief this morning. Oil stocks to note.
Yeah, very much in focus. So broadly speaking, Asia-Pacific oil stocks, we're down 3 straight days. We're catching a bid there, and we are somewhat, as you can see, in some cases, Sinopec more on the downstream side of things, 0.25% to the upside. Futures are pointing slightly to the upside in the pre-markets. The open is next. This is Bloomberg.
Welcome back. You're watching the China Show and counting down to the open of markets this morning. We've got futures here that are looking for a fairly flat start to the day. We had US markets that were shut Thursday for a holiday. Equity futures have been a little bit under pressure, of course, but the big story for the session today is Donald Trump, or at least his spokesperson, saying that he's weighing whether to strike Iran within the next 2 weeks.
Yes, and I think as Jill Deeses, our news desk editor, pointed out, it doesn't mean you table the story and come back in 2 weeks. It effectively means anything can happen. And I mean, does it, I guess, in some ways distill some of the risk premium that's been built into going into this weekend? Not necessarily so, but in some ways, when you look at the oil price, for example, has been very tight in terms of the actual price range. That might indicate that maybe the near-term top is here for now, unless we, of course, get a really more blatant escalation of the situation. But in any case, of course.
To your point, I mean, Jill said it's very much a live decision or situation, and you've got Israel as well that's saying that they are prepared, or at least seeming to be prepared, to act unilaterally in this situation as well, and saying that they've got at least some within the government camp saying they have the capability to bring down Tehran's leadership as well. But that's sort of the bigger picture story coming into the session today. As we said, look, the CSI 300 is fairly flat today, not too much movement really. The Yuan, of course, we had that Yuan fix.
Strong.
A very strong one, actually the strongest I think we've seen going back to March of this year. So watch those currency fluctuations throughout the session. But yesterday, really, it was Chinese equities that led the benchmark lower in Asia. off these Middle East tensions, and we saw it in the tech story in particular. Let's actually take a look at how Hong Kong's coming online, because we can see the likes of Alibaba, Tencent as well. You are just seeing here some modest gains to the upside, but again, I expect it to be largely a range-bound session, especially because you had US markets that were shut Thursday. Pop Mart to note, let's just take a quick look at how those shares are trading, because we've just had some commentary out in local media in China saying that there needs to be greater supervision of so-called blind boxes, but that's the whole sort of story around Labubu. You buy Labubu, you don't know exactly which one you're going to get. Regulators are concerned maybe that also leads, I mean, it can be addictive, basically, not just for minors, but adults as well. It's not clear, though, what type of supervision is perhaps ahead of us. I think it's clear that there is regulatory risk still, but I guess to the point you were making, it's just a warning on the box. You're right. Maybe that would be enough. Yeah, it's not like they're forcing. It's not like they're forcing the company to go, okay, you have to tell us what's inside the box, because that then takes away the whole thrill. I think so, and it was such a win. It's a cultural win for China on the global stage. It's another example of them being able to export that soft power, essentially. But anyway, we'll leave that there, because we do have a big toys on that note. Yeah. Okay. They're very popular. Okay, let's get the take now on equity markets, the soft and the hard, the plush and the not, from Societe here across the Asia-Pacific equity complex. So recently they upgraded Korea and raised index targets on your screen, some of them on your screens. Let's get a sense right now of how things stack up right now and what the rationale is behind some of the recent moves here with Frank Benzimra, head of Asia Equity Strategy at Societe. Good morning and happy Friday morning. Why don't we start in Korea? Because that seems to be one of the main takeaways here. What the upgrade? I mean, the market's done exceptionally well this year. Is there a risk that the upgrade is too late? What's the rationale behind the upgrade?
No, that's not too late.
Okay.
And what we believe is that well, there has always been. You look at Asia, you have two big markets which are very much undervalued. One is China, the other one is Korea, which over the last 10, 15 years in US dollar haven't done much. And looking specifically at Korea, you have this big undervaluation, some call it the Korea discount, which can be explained by some governance issue. Beginning of last year, we had some attempt to reduce this discount, which failed, and now we have a new policy momentum. And this is happening at a time when the new leadership, the new president, has a majority in the parliament, where the stock market has been a subject of the election, and where at the same time, more looking at the fundamental, we start to see earnings momentum shifting, because what we see on the flash memory price is bottoming. So we have a combination of policy, fundamental, earnings, which makes the case for Korea becoming much, much more interesting. The Value Up program, though, at least if you take Japan, for instance, as the example, it did take many years to actually get going. So do you expect the rollout of that to speed up at all with the new administration? It took many years, but it has been rather effective, especially in the last 3 years. And you look at the Japanese program, what was very interesting, it was a combination, it was a part of a broader policy framework to lift growth, and the stock market and the governance reform was part of this broader package. And now what we see is you took in Japan, you had the GPIF shifting the allocation to equity, and now, well, you have, well, in Korea you don't have the GPIF, but you have the National Pension Service, on which the weight of the foreign securities has been quite elevated. So if we want to be a little bit creative and think of the unthinkable, why would not we have the National Pension Service also raising the part of the domestic equity? And this is where the thing could be interesting on the Korean market.
One last question, I guess, on Korea. The conversations around, is it an emerging market? Does MSCI or some of the index compilers, do they look at them eventually as becoming a developed market? It doesn't seem to be the case right now for MSCI, at least on the surface. How do you think about that? How does that change the outlook? Is it a good or possibly a a bad thing that it becomes a bad thing, it becomes a developed market in that sense?
In terms of flow, it's not going to be a positive. We calculate that there would be some outflow if Korea goes into the developed market. Now, what it means to go to a developed market in terms of trading, in terms of currency, so that could make the valuation of the stock market better. So yes, that could be a positive, but certainly not because of the flow.
Yeah, I guess the big question really for Korea is you're sort of like you're a big fish in a small pond, and if you become a developed market, you're definitely a small fish. But the question as well about China, because you're looking at that sort of consumer stocks case and how that's changing as well.
Yes, so well, China, it's been well, exactly 1 year ago we increased the allocation to overweight, mostly on the advanced manufacturing, on the industrial technology, and now we are looking at the consumer stock. And the reason why we are looking at the consumer stock is we start to see in the earnings in the first quarter and what we see recently a bit of improvement, whether it is on the revenue side or in the operating margin. At the macro level, retail sales were not that bad in the month of May. So I think that could be the next story on the Chinese stock market.
Are you concerned at all with the, I'll take EVs as an example, maybe solar, lithium, the overcapacity and some of the fierce competition that we're seeing there has started to show up in things like food delivery. How do we need to be thinking about that from an earnings perspective if we are bullish on the Chinese consumption play?
Yeah, so certainly you have some issue of overcapacity, which could be much more in some green transition related industry more than anything else. Looking elsewhere, the capacity utilization is actually not too bad. So, okay. But yes, certainly you look at the automobile sector. Well, there is a very tough competition, and we know that there will be just a few survivors in terms of making good earnings. Generally, we prefer to be on the very large cap and the one which can take some market share and which have some ability to export as well.
Other markets, you're neutral on India, but you're underweight Indonesia, Malaysia, and Thailand. So, yes. What is it about Southeast Asia in particular? Is it the exposure to trade risks or trade wars?
No, actually, ASEAN is very interesting because it's from an economic point of view. Actually, they have increased trade both with the US and with China, so they are rather well positioned on that. But the economy is not the stock market, and when we look at the equity market, what we see is that valuations are not very elevated, but not that much on the earnings side to make us very enthusiastic. The only good thing is that we start to see some flow coming back, and that's actually one of the core themes that we have in our outlook is that equity flow, it was quite negative even with the dollar peaking, and now we start to see some money coming back, but it's now mostly on Korea and Taiwan.
Yeah, I mean, the title of the report is The Great Rotation Extending into the Asia Pacific, yes, in terms of the outlook here. How are you looking at the dollar? And does that underpin the thesis? And what's the risk to the thesis?
Yeah. Well, we try to remain simple when we do this kind of outlook, and we look at the price which matter for Asia equity and more broadly for emerging assets, and it's dollar, it's treasury, and it's the price of oil. And what we see at the moment is two of these price, the dollar and the treasury, which remains the yield on the 10-year in the US remain rather range-bound, are okay, and actually are quite constructive. Now, of course, we see the price of oil has been under pressure. We take a little bit of a broader outlook. We think that oil will be at 60 at the end of the year and could even test 50 at the end of 2026. So overall, we find that's a pretty good environment for emerging assets. So going actually beyond this equity outlook that I have produced last week is the overall emerging asset is one of the very interesting part of the world to play this rotation.
Frank, Thank you so much. And, let's hope the projection on oil is correct, because it certainly implies a better sort of geopolitical environment as well. Frank Benzimra, their head of Asia equity strategy at Societe, there. The great rotation extending into Asia as we, I guess, in some ways rotate into the weekend here. Coming up here on the China Show, it's the clash of the toy titans. We track the rapid rise in China's Labubu and its owner Pop Mart, and ask whether or not the current craze has the staying power of Hello Kitty. There we go. Morningstar analyst joins us. Both cover both companies separately, so we'll get the bull and the bear cases, or the monster cases if you want to take the Labubu terminology on that. Plenty more ahead this time, the next hour, of course, that comes up. This is the China Show.
Japan is expected to reduce its issuance of long-dated government bonds as it seeks to stabilise markets. And it's seeking feedback from market players in a meeting scheduled for 4 p.m. today in Tokyo. For more, let's bring in Bloomberg economy and government editor Paul Jackson. So, Paul, I mean, the dynamics, this has been, of course, very much watched part of the curve. So what's exactly happening at the very long end in Japan?
Well, we've had some considerable change to the dynamics of the bond market. I think we've got three things we need to look at. We've got the normalisation of policy, we've got changes in regulation, and we've also got inflation. So if we look at the normalisation of policy, we've got the central bank pulling back from the bond market. And as we saw earlier this week, they've realised that perhaps they've been pulling out a little bit too quickly. So they announced a plan earlier this week to just slow down their withdrawal from the market. Now, they've been buying enormous quantities of bonds. They own half the national debt of Japan. So even following their target, they're still going to be buying about $14 billion worth of bonds a month by the first quarter of 2027, even with these reductions. But the fact of the matter is it's less demand in the market. So that's going to cause volatility unless people can fill that space. Now, at the same time this has been happening, regulatory changes have meant that life insurers are no longer obligated to buy at the super long end. They can buy at the shorter end. Meanwhile, mega banks, kind of a hangover from the global financial crisis, the Basel III regulations, means they're limited in how many of these super long bonds they can buy because of the interest rate risk. So all of this comes together in like a perfect storm for the volatility at the super long end of the range. So what we're seeing now is the Bank of Japan took this action to kind of prop up demand earlier this week. And what we're going to see today is the finance ministry likely trimming its issuance at the super long end. The plan that Bloomberg has seen suggests about a 9.3% reduction in the issuance at the super long end of the range, and so then that brings the supply down. So what we're trying to see, policymakers essentially trying to bring the balance back to this super long end of the market.
Yeah, reduction on the long end, and as you go into even the extremely short, the 6 month, that's probably where we're seeing an increased supply. Paul, thank you so much for that. Our Bloomberg economy and government correspondent, they're talking about, an editor talking about really what we need to see as far as this specific one is concerned. I think it's at 4 or 5 p.m. Later today. Paul Jackson, thank you so much. That was the long and the short of it in many ways. Okay. We have more analysis coming up here. JPMorgan Asset Management in the next hour, talking all things fixed income and what has worked so far this year. Things like high yield, things like local markets have done extremely well. Does that continue, or do we need to start looking elsewhere? Julio Callegari joins us in about 20 minutes from now. This is the China Show. Welcome back. Some of the corporate stories we're tracking this morning. Hong Kong developer New World is said to be close to securing an $11 billion loan here. That's a refinancing deal, of course. Now, sources say it's received prelim consent from all of its lenders for the deal. Now, the agreement's success hinges on securing full consent from over 50 existing banks by the end of June. New World will also have to put up additional collateral for almost $3 billion in loans due in 2027 and also beyond. Now, we're tracking the mainland listed shares of Chinese heating system supplier Zhejiang Sanhua. Now, Bloomberg has learned that the company has raised $1.2 billion here after expanding the size of its Hong Kong share sale. Now, it's said to have priced at over 400 million shares at the upper end of the price range. Demand was said to be strong enough to trigger an option to sell that 15% more than they originally planned.
And the CEO of IMAX China says he expects the company's market share to grow in the double digits as it aggressively adds screens across the country. The company's betting big on local and also US productions to boost sales. And Daniel Manwaring told us exclusively the movie industry is yet to feel any impact from the trade war.
Business is really as usual. It's pretty great to see. You know, the process of importation is really been very smooth. These films are getting dated with regularity, and you know, there's really nothing very much changed that we've seen over the past few months, and we expect that to continue. So I hear about this trade war, but we haven't exactly felt it directly hit our business.
Why is that? There was a lot of noise, obviously, with the tariffs and Donald Trump's proclamation about bringing films back to the United States and tariffing foreign films that come into the United States. But is that all a bunch of nothing? I know Richard, your boss, has talked about it's just a bunch of noise, but it hasn't been impacting you?
You know, I got to agree with my boss, right? It started out, you know, with a couple of bloggers that basically started some online rumors, and there was about a week of frenzy around it, and then, you know, 7 days later, it was very clear that business was back to usual. So I think there's always been a lot of noise, and there will always continue to be some noise. But for our little sector, we're pretty protected from a lot of the outside noise.
What did Ne Zha 2 basically do to the industry? Because that was really the tentpole for the box office success of late. And there is some concern that after that runs its course, that maybe the demand will taper off.
You know, for me, I think Ne Zha 2 proved one simple thing. The audience is there. If you make a good movie, the audience is there. And they showed up in huge numbers. We, year to date, a lot of help from Ne Zha 2, have seen 22 million in attendance for IMAX. Right. That's a very large number. And so I think, you know,
it was double year over year, wasn't it?
It was double year over year. That's great. You got your numbers there. So I think it proves that the theater-going audience in China is really strong. It's really about the content supply.
But how resilient is it? I mean, the economy is not doing as well as authorities would like, no doubt. And people are holding on to their discretionary money, their household savings.
Mm-hmm. Well, I think that going to watch a movie is still a really high ROI for people. You know, you're paying less than $10 to be entertained for 2 to 2.5 hours. In the summertime, it's air conditioned. You know, you've got popcorn, you've got Cokes. I mean, in terms of time and money, I think it's still a really high value proposition. So I think that's one of the reasons why we're still seeing a lot of growth in our market share. Again, year to date, we're doing 5% of the total box office in China. That's the highest we've ever done in any year. And I think people, again, it goes back to wanting that premium experience for what is, I believe, a really reasonable cost.
What would be the target then, from 5% to what over the next 5 to 10 years? Of course.
From 5 to 100.
You're taking that to Richard and saying that's our business plan for the next 5 years?
You know, no, we don't give ourselves sort of a target number. Yeah. I mean, we have less than 1% of the total screens in China. We've got about 800 screens in China. So, you know, doing 5 times that in box office is something we're really proud of. But always, I think there's room to grow. And we're going to be pushing the limits into double digits.
There we go. Daniel Manwaring there, IMAX China CEO with, of course, Steve, just talking about the film market and many other things. Right. Back to what we're tracking right now. This was, I guess, to some extent unexpected, given, I guess, the price reaction you'll see. We were down as much as 6%, in fact. We're down 3.5%. And the People's Daily underscoring now a fresh risk that investors need to be thinking about, not just so much demand or how clear demand is moving forward, but also regulatory risk when it comes to Pop Mart.
Yeah, that's right. I mean, they're saying that essentially it needs to be stricter. We're a little bit unclear on the details. That stock did drop around 6% in pre-market, so you're off the lows of the day, but still in negative territory, rather. Taking a look at game stocks as well, because these are actually gaining this morning here. We did see some support from Beijing for the esports sector, and that's, of course, been a long-time policy support in place. A little bit mixed there, actually. But leave you with a look of China dashboards nearly half an hour into the session. Welcome back to the China Show. Taking a look at the Hang Seng half an hour into the session. It is range bound, really. I mean, we're set to snap a 3-day losing streak here. We did see Chinese equities generally really pulled down by the ongoing tensions in the Middle East. But I do think it's worth pointing out as we go into the weekend. You did have the US market holiday on Thursday, but today the Hang Seng trading volumes are around 20% less than where they typically be.
Yeah, so for those who are at work today in the markets, at least they're bidding this one up. I think it's also worth pointing out, I think going into the weekend, we are hovering still at about, I think, multi-week lows as far as volumes and price go. So it has been very, very range-bound. It's also worth pointing out that we are going into some technical levels that might perhaps also explain why we are catching a bit across parts of this market. Other things in China today, you have a 3 and 20-year, I think it's a 3-year auction. I'll correct myself. I think it's a 3 and a 20-year bond auction today. No change in loan prime rates. And there's some news as well as far as Labubu is concerned. We'll get to that a bit later on. Okay, what else are we looking? Oh, K-pop.
Korea.
Yeah, K-pop. Here we go. What's the level? 3,000 for the first time since
2022.
There we go. Thank you so much. One of the best performing markets this year. I think it's top 5 globally on a main index basis. And Frank Benzimra, who joined us from SocGen, underscored the bullish case here for Korea earlier.
Yeah, so just talking about the Value Up program, yes, it's in the early days, but it could possibly unlock a lot of buying. And also he was talking about the pension funds and whether they would actually start to have greater purchasing of equities as well. And that could also be something that underpins greater momentum. But they're very bullish on that market. They just upgraded it to overweight.
There we go. Let's have a look at the rest of the region, though. And yeah, I mean, to Belle's point, right, the closure in U.S. markets didn't really give us a clear lead. U.S. futures are off lows of the day, but still down. And certainly the story, which we'll get into in a moment here, is, how do we need to be looking at this new time frame from the White House of 2 weeks? Is there a hard deadline there? Is that simply just to alleviate some of the pressure near term going into the weekend? Very, very quickly, some of the technical levels we mentioned on the Chinese benchmark itself. It's been a while since we've seen the bounce off the 100-day moving average, and as you can see, we're sitting right on top of that yellow line as momentum starts to fade, and we'll see what the next few weeks holds, of course, as far as the benchmark is concerned.
Yeah, but as you said, we're very much focused on what's happening in the Middle East. And to that point, Israeli officials say that they can penetrate the uranium enrichment hall at Iran's Fordo nuclear site without U.S. assistance. This comes as President Trump says he will decide within 2 weeks whether to launch a military strike on the Islamic Republic.
I have a message directly from the president, and I quote, "Based on the fact that there's a substantial chance of negotiations that may or may not take place with Iran in the near future, I will make my decision whether or not to go within the next 2 weeks."
Let's bring in our senior editor, Derek Wallbank, in Singapore. And Derek, I mean, David just alluded to it there before, but 2 weeks deadline now from President Trump. It's definitely not a situation where you want to set and forget and review in a fortnight. What do we expect to happen in the interim?
Well, yeah, I think 2 weeks is a really interesting phrase as well. And so I have to start there. 2 weeks is a Trump framing that he has used for a ton of things, and it doesn't necessarily represent an exact time period with a hard deadline. It's basically, I'm going to try and get to this soon, probably. Doesn't always happen even. 3 weeks ago, we were told there were going to be some new trade deals in a week or two, and we haven't had any ones since the United Kingdom. So it is very possible for that time period to be both shorter or that exact time period, or longer, or not at all. So that's the first thing I have to start with. Don't think of this as a deadline. Think of this as like we're pushing and the deadline's not necessarily imminent. So that's the first thing. The second thing is, I note that, and you very, very smartly, I think, noted in here that Israel has said that it may have the military capabilities, or it thinks, to do some of the things that previously analysts have said only the United States could help do. That may ease some of the pressure here for the president. But look, he has gone and, over the course of the last week, given himself a lot of political space, as well as you've seen the U.S. Pentagon moving assets about, so that if Trump were to make a decision here to do something and escalate and join Israel's offensive, that he would have the ability so to do. So it's very much still in the frame.
Derek, let me borrow that last phrase you mentioned, joining Israel's offensive. Is that a hard or an easy sell domestically for Donald Trump?
Well, it's a complicated sell, certainly. The U.S. has, I think, now a quite big wariness about entanglements, particularly in the Middle East. It is very popular as a mainstream position to say, we want to take care of the U.S. and sort of let other things, be handled by other folks. Indeed, that is an undercurrent of Donald Trump's whole foreign policy, and it's one of the reasons that he was elected. At the same time, Trump is trying, he's been very clear for years and years and years, Iran cannot have a nuclear weapon, and that has been an underlined thing. Now, Trump has tried to say that some of the people on the MAGA right who don't like this, who are more isolationist actors, that they've misread him and that they've misread where MAGA is and all of that stuff. Maybe so. And certainly there's not necessarily going to be a congressional constraint coming in here. We have heard noises about the idea of forcing a vote on a war powers resolution. The earliest that would come is next week. So that's also not really on the table in terms of an imminent time frame. But politically sort of wider, I do think that there is, after Iraq particularly, a reluctance among a lot of the American public to want to go in and get involved in another Middle Eastern entanglement. So that is something that would be that he would have to find a way to message. And I'm not sure right now that there's been a lot of messaging that Iran is an imminent threat to the United States. So that would be certainly, I think, a big obstacle. The other thing I should really hit real quick, David, is that if this escalates, you do start to see some problems for Main Street in the United States, right? If Iran, for whatever reason, decided to try and shut the Strait of Hormuz, you see analysts saying that that could take oil prices from the high 70s into the 130s. The pain at the pump, so to speak, the U.S. gas prices are advertised on billboards at every station. It is the most visible economic indicator of inflation in the United States. If that starts to happen, you start having domestic economic pressures, not to mention what could happen with U.S. markets, when you tend to have haven plays when there is a crisis going on, and all of that sort of thing. So there do become negative domestic political and economic ramifications if this were to escalate in a significant way that the White House would also have to be weighing at this point, along with all of its military strategic objectives.
Derek, thank you. Derek Wallbank, our senior editor in Singapore for us. And as really Derek was pointing out, right, so it's easy to forget that we're still in the middle of the tariff conversation. And now we have another potential vector of inflation coming through in the form of oil and potentially shipping prices, which some of our analysts here at Bloomberg Intelligence have also pointed out. Again, that's the global relevance of that. But on the oil market specifically right now, and how we need to be looking at oil prices going into, again, another weekend. Nicholas Lua joins us, our oil reporter from Singapore. And Nicholas, let's start off with Iran and how exports are faring amid what's going on there. We have some data from imagery. What is that telling us specifically?
So the Bloomberg oil team has actually used satellite imagery to look at the straits. And what we're seeing is that Karg Island, the key export terminal that Iran uses to send its crude out to the world, now that's actually been pushing out cargoes as quickly as it can. If you look at satellite images, storage terminal levels are actually really high, but that's not an indication that people aren't moving cargoes. It's actually the opposite. The Iranians are pushing cargoes into the storage terminals as fast as they can. And what we're seeing is that on the tanker front, tankers are actually ducking into the Straits of Hormuz over to Karg Island, picking up the cargoes and getting out of there ASAP. And that's the pattern that's been going on. So Iran's actually seen oil exports go up 44% since the conflict happened. And so that's the way that Iran is trying to mitigate and work around what could be a crisis that has the potential to escalate even further.
Nicholas, just as you're speaking there, we actually just got an update on the situation over in Washington with a line out saying that President Trump is planning to attend a national security meeting at 11 a.m. on Friday. So this, as we've been saying, is very much a live situation, even if President Trump is saying he's going to delay any sort of decision-making for a further 2 weeks. But where we have also seen really sharp moves off the back of these Middle East tensions is in the diesel markets. So why are we seeing such a big impact there in particular?
So diesel is the workhorse fuel of the global economy. And I think even before the conflict happened, what needs to be understood is that supply levels were already under pressure. Now, if you look at the U.S., supply levels, inventories, they've been at seasonal lows. And if you look at Europe, Europe's actually seen a couple of refinery outages, meaning that diesel production has been crimped. And so the market was already under pressure to start with. The Middle East crisis risks the possibility of even more supplies being cut. If you look at the Persian Gulf, you look at the Gulf of Oman, there are major refineries around that area that last year, according to Vortexa data, pumped out something like 850,000 barrels per day of fuel. That much diesel fuel passed through the Straits of Hormuz last year. And that's all supply that could stand to be disrupted. So I think we're all on edge. And what a situation going on in the U.S. With Trump, like he needs to be paying attention to all of these things as he makes his decision on how to move forward.
Yeah, absolutely. And to that point, that line we just got, the president attending a national security meeting at 11 a.m., that was from the White House daily schedule. But thanks so much for your time. That was our oil reporter, Nicholas Lua, there in Singapore. And we're going to get more analysis on how this Israel-Iran conflict is shaping up and the potential role as well for the U.S. We're going to be speaking with the former Assistant Secretary of State for Near Eastern Affairs, that's Barbara Leaf, joining us later today at 2:30 p.m. if you're watching here in Hong Kong, 4:30 p.m. as well over in Sydney. But this is the China Show. We've got a lot more ahead, and you're watching Bloomberg.
It's been an extremely busy week on the central bank front, so if you can make out some of the flags on your screens. Long story short is, so obviously you had the Fed, you had the BOJ, Bank of England, and then you had some surprises coming through out of the Scandic, like Norges Bank, for example, coming through with a cut. You had the S&B coming in and taking rates to zero. And apart from all of that, it seems like, so Europe was, certainly you had 3 cuts, I think, in 24 hours there. And you had cuts as well coming through out of the Philippines, despite perhaps the, that specifically the worst week for the Philippine peso going back, I think, 15 years, with the exception of 1 week. But so it's been a 3 sigma move there, and a hike out of Brazil. Right. And we haven't even talked about the JGB story, which we'll get more details on later on, of course, out of the finance ministry and what they plan to do with the curve and the supply there across the JGB curve. Yeah, why don't we talk? Oh, okay, let's talk about this with Julio Callegari, CIO of Asia Fixed Income at JPMorgan Asset Management. So 2 things, at least for me, have emerged this week. One is the rate differential story seems to be favoring dollar assets. the other thing is, it doesn't seem like we have any clarity on what the Fed, even they don't have any clarity amongst themselves where they are going to take interest rate. How does that inform you about the winning strategies from here?
Right. So I think it's indeed, when you look from pure rates differential, it's quite of a surprise to see the dollar weakening, but that's what we've seen this year.
Yes.
Right? And I think this has a lot to do with positioning. The market was, generally speaking, loaded with dollars because this has been accumulated for years and years. So even though we have the rates differential that in theory would not make compelling, the investment in the local space, but that's not what we are seeing. So I think one is about positioning. The market was already loaded with dollars. The other has to do with the underlying inflation story. Particularly in Asia, what is happening is inflation was already low, and actually when you look forward, the outlook is to be even lower because there is no tariffs, which is very different from the narrative from US, right? And on top of that, the market is thinking that tariffs, if anything, will rechannel goods away from, US to the rest of the world. So that's why you see the local markets performing so well, because we've seen central banks cutting rates on the back of lower inflation. So you have a capital gain related to lower yields. And on top of that, dollar is getting weaker. So that's why local markets has been outperforming.
Do you think investors are really picking up on that dynamic, though, that outperformance?
I don't think so. Actually, when we look at the flows, we see very muted reaction from investors in terms of investing in local space. So I think probably this is unloved, rally in the local space.
Why is that?
I think it's because for some time, this area underperformed, right? It was sort of a no-brainer to buy U.S. assets. The dollar was appreciating most of the time. It's also very balanced when you buy, let's say, in the past, you would buy U.S. equities, and this would have a negative correlation with dollar, meaning that if you lose on equity U.S., you would gain on the dollar. What is happening now is that correlation is breaking. So this is the new news, and that's why I think the market is missing it, because it was not a normal reaction over the last years.
Well, I think the other question is, does it continue in your view?
We think that there is room for this to continue. One of the key, or perhaps the main reason, has to do with the fact that the market is realizing that U.S. will not be always exceptional. If anything, when we look forward, we see growth differential moving against U.S. We think the second half of this year, U.S. will start to clearly slow, while we see most of Asia, including China, India, Indonesia, holding up relatively well, for example. So there is less of this U.S. exceptionalism story in terms of growth. The other part of the story, as I mentioned, is indeed about inflation. If anything, there is a risk of higher inflation in U.S., but not in most of Asia. And then the other and final part is the steady, current account surplus in Asia. So there is like $1 trillion per year of new surplus being generated in Asia. And in the past, this was clearly channeled to U.S. assets. But we think that, with what is happening now, investors will really think about some diversification. And this is something that could take longer, took a very long time to build all these assets in U.S. and in dollars, and we think will take some time to diversify.
What's the way that you want to get exposure? Is it dollar denominated, local currency, corporate, high yield, investment grade? What do you look at in particular?
Right. So I think definitely the local space is something that investors should look at. Either you could pick more high yield profile, let's say bonds in Indonesia, right, in which you still can get 6-7%, right? But we think that even in lower yields with higher quality, this will also be part of diversification. I know that is not compelling when you look at face value to buy, let's say, Malaysian bonds at 3.5 or Singapore bonds, even lower yields. But truth is that this is probably part of the diversification. There will be like a home buyers again to buy those assets. So this is something that probably will linger.
When something is as clear-cut as you've outlined, I tend to get scared because there doesn't, I can't think of a risk. What risks are you looking to manage here?
You're right. I think we should not be, just closing our eyes and saying the dollar will always get weaker here. Because actually, in terms of risks, one is what if the Fed is way more hawkish than people are expecting, right? Because as we discussed, it's possible that inflation will be stickier and then the Fed may sound quite hawkish. So this will reinforce the rates differential in favor of the dollar and at least for some time could push the dollar stronger, right? So I completely agree. It's not something that is close your eyes and sell dollars. But I think what we are talking here is more like the medium-term profile in which some diversification will happen. And this, probably as a catalyst, will be triggered when the Fed is actually cutting again, right? Then it will be more obvious that, as we discussed, U.S. is not that exceptional, and rates differential start to move against U.S. again.
Julio, thanks so much for joining us this morning. That was Julio Callegari, the CIO of Asia Fixed Income at JPMorgan Asset Management. And coming up in the next hour, we're going to get more analysis on the geopolitical risks with Alpine Macro and Javelin Wealth Management. That's on Insight with Haslinder Amin. You're watching The China Show, and this is Bloomberg.
Welcome back. You're watching The China Show. So in only 3 years, state-run Chinese trader CMRG has emerged as the dominant player in China's $130 billion iron ore import market. For more on this story, let's bring in our Asia Metals and Mining reporter, Catherine Gemmell, to talk the details through this. And let's talk about the how and how, I guess, China, the country, is looking to take greater control, really, of one of the most volatile commodity markets here.
Hi there, yeah, exactly. So CMRG was set up a couple of years ago with the aim to get the power really away from the global miners back to the steel mills in China. And over the last couple of years since its creation, we don't really know much about exactly what it's been doing. It's been quite mysterious and it's really sensitive in China as well. But it's emerged through our reporting in this year that they've really enhanced that control. We see that they've got significant stockpiles of iron ore at Chinese ports, which they're feeding into the market when it's tight. And really helping to solve that volatility which iron ore market has once been very known for. So they're really flexing their muscles and making their presence known now.
This is obviously, as you said, making their presence known and something that could have really big ramifications, especially for the major iron ore companies or mining companies in Australia in particular. But what exactly is at stake here?
Yeah, exactly. It's a really good question. I mean, from our reporting, we found out that CMRG now represents over half of Chinese steel mills. So that just means that, the bargaining power of those steel mills against the global miners like BHP Rio and Brazil's Vale when they're negotiating contracts is really shifting. So far, we know that the big miners don't currently have any long-term contracts, but they are just focused on spot contracts with CMRG right now. So it just shows that there could be a massive shift in this massive market. And that power could slowly be going back to the steel mills. To be sure, obviously, the iron ore market is super dynamic. You've got low-cost suppliers, and there's a real focus on quality. So although that shift in power is enhanced, it might not be absolute.
Thanks very much for joining us. That's Catherine Gemmell there, Bloomberg's Asia Metals and Mining reporter from Singapore. But we will have plenty more ahead. We are just about an hour into the trading session so far for Chinese equities. We're lifting off the lows of the day, but you still do see China equities sitting a little bit flatter than what we see for Hang Seng, that's gaining with tech really in the lead. More ahead. Taking a look at markets in Japan this morning, we are sitting fairly steady. It's actually been a relatively big morning for Japan in terms of the economic data because we saw core CPI, for instance, outpacing economist estimates, so rising 3.7% on the year in May. But also we're looking ahead to a very big meeting later today with financial regulators talking about the outlook for bond buying at the long end of the curve.
Yeah, our understanding based on, I think, the draft of what they're going to be talking about came out is that a little bit less on the long ends and perhaps additionally, but a lot more when you look at the focus that shifts into the short end, including tenors below a year. Now, a lot of this is just to say that Japanese regulators are talking to the market because, for many, many years prior to this step that we're looking at right now, that they're stepping back from the bond market, people were saying, okay, so who's going to step in? The BOJ owns so much of this market, and then who's going to step in to backstop demand? And here we are feeling the pinch of that with yields in Japan, of course. Now, it doesn't seem like a lot, but, who would have thought we'd be at 1.5% on the Japanese 10-year yield just 5 years ago? But in any case, of course, we can table that for now. The other story that we're following here is some news on one of the most loved longs in the market. This is long Labubu trade.
Long Labubu, yeah, it's Pop Mart, of course, and I think it's pretty exceptional on a day when you've got all of these Middle East tensions that are ongoing. You've got things like that Japan data you were just talking about on the outlook for JGB buying. This is actually one of the most read stories of the day so far, but it's a bit of a warning, essentially, that's come possibly from regulators, but through state-backed media in mainland China. Let's get more on it now, bringing our Asia Equities reporter Charlotte Yang joining us this morning, and not just you, but you've brought some Labubus along with you. So
unfortunately.
Should I showcase it?
Yeah.
Bring it together for us. What's going on?
The guest of today.
Yeah, why don't you introduce your friends?
So this is so the IP is Labubu, is one of the monsters IP of Pop Mart that's making popular everywhere on social media, TikTok, Low Red Note. This is a plush toy and this is a blind box. So they are the two different businesses of Pop Mart, but essentially a key driver of why the shit's been doing so well. Okay,
well, talk to us then about arguably too well, at least the attention on this, that it's caught the attention of somewhat regulators here because of this People's Daily report.
Yeah, so today, we're seeing some of the profit-taking weakness in the shares. So essentially, People's Daily, China state media, they ran a story on the 19th page, so talking about there's some concerns with trading cards and blind boxes. So they didn't name any company in the story, but nonetheless, this kind of reignited some of the worries investors had before. So before 2023, regulatory concerns of blind boxes had been weighed on Pop Mart shares a lot. But then, since then, in 2023, the authorities have put forward a regulation talking about how you're not allowed to sell blind boxes to children under the age of 8. So today was kind of like a reminder of some of the overheating, when it comes to so popular.
What exactly, though, because this is a point that David made earlier, is that even if there's sort of like concerns around stricter regulation, I mean, it can take a lot of different forms as well. So do we know any more details on what it could actually look like or when it would be enacted, for instance?
Yeah, so far, I don't think, regulatory concerns still high up for investors. First of all, this is still a story, on state media. Didn't come directly from the government. So I think so far, the concerns investors have for this company is still more on the valuation side. So you have the shares trading at 39 times. That's way higher than Sanrio and also peers like Disney. And the risk was, this always comes like a cycle, right? You had Beanie Babies before, toys like this. But I think the difficulty is to call the fashion risk of this, and also investors closely watching how, for example, these Labubu toys, their prices in the secondary market, as a way to gauge how the demand will continue to be.
Yeah, or the pet rock, right? Wasn't that a thing as well that you had immense margins on? Anyway, I'm ranting, but I'm going to borrow these for now, Charlotte. Well, I thank you, and you have a good weekend.
Thank you, Charlotte, for
thank you so much
them.
for that. Yeah, you'll see them never. Okay, Charlotte Yang there
on eBay next.
yes. This is for happy hour later. We'll see how much liquidity these things can get. All right. Okay. Speaking of, I think Charlotte just talked about the market cap there for Pop Mart, and here's like almost a comparison between the two companies and the trends that we're seeing here. What did you talk about, Isabel, a little bit?
Well,
share price, market cap, much more expensive stock as well.
Yes, and there's obviously, yeah, one's looking maybe fairly valued. That'd be Sanrio. One's looking overvalued, as you said. That's Labubu right now. That the future initiatives and growth drivers, they look kind of different. I mean, Pop Mart, for instance, could be going down the track of more plush and mega toy series, media products, jewelry and theme park operations. Wow. Sanrio, though, is kind of looking more at that licensing route. So sort of different paths ahead, and certainly different risks for the companies as well.
Yeah, because how visible are earnings really, right? You could make the argument it cuts both ways, right? We can't see visibility a few quarters down the road, but it doesn't mean, of course, there won't be as much or even more explosive revenue moving forward. And I think when you look at the price targets on the street for the stocks themselves, I think you're going to have this come up on your screens very shortly. The latest one to come through this week was JPMorgan at $330 a pop. On Pop Mart.
That was yesterday, yeah.
That was yesterday. Consensus at 246. We're slightly below that because of the profit taken today. On the extreme end of this is Goldman Sachs at about 150. And just to note, like, these are price targets that have been updated from the sell side in the last few weeks or so. So rather updated versions of what their calls are for these stocks.
Yeah, and as you said, I mean, they're really drastically different price targets on the stock. But I think, one of the main questions around this is really the Labubu's craze. Does it have staying power for Pop Mart? And Sanrio, of course, is, as we know, have been saying, it's a Japanese company. Its characters include Hello Kitty, for instance. It's still returned investors nearly 650% since it listed back in 1982. So that's a phenomenal gain, really. But that includes share price gains and dividend payouts. Yeah. Regardless, of course, the hype around Labubu, as we've been saying, it's very hard to ignore.
No, I mean, how many times have we talked about it on the show today? But there is news today. I mean, we've talked about this so much, really. In fact, on that very note, why not even more?
Yes, that's right. We're going to bring in the sole analyst who has a sell rating on the stock, on Pop Mart, that is. That's Jeff Jung from Morningstar. We're also joined by his colleague covering Sanrio, Pujans Chan. So let's start then with this sell rating. I mean, it's why is that your take?
Well, instead of providing buy-sell recommendations, we focus more on the long-term competitive strength and the intrinsic value of a company. Okay. So for Pop Mart, our fair value estimate right now is still below its current share price, which suggests overpricing for now. This mainly stems from our more conservative risk outlook on its IP business. As you have just mentioned, Labubu and other IPs launched by Pop Mart have received tremendous popularity worldwide. But there's no guarantee that what's prevalent now will continue to stay relevant over the longer term. So this is the inherent risk of an IP business that we have noted. And also compared to established peers like Sanrio and Disney, we think that the diversification of Pop Mart's business outside of Pop Toy has been at initial stage. And so it may still take decades for Pop Mart to pull things off. But right now, we're still at initial phase, so uncertainties remain. So overall, we think we have factored in a higher risk premium than what the current share price suggests.
Okay. Pujans, before I bring in, I just want to ask a follow-up to Jeff here, really, on so the thesis is it's slightly overvalued, and you don't think there's a moat around the company.
Yeah.
What does a company need to do to form some sort of moat?
I think, first of all, it needs to demonstrate, it needs to prove that over a longer duration of time period or cycle, it can withstand the fluctuation of the consumer's preference. I mean, if we take Labubu as an example, its sales have taken off since 2023, and even more so in 2024 and this year, given the successful marketing campaign in Thailand, for example, and also the craze that's been spreading globally over its pop toys. But we think uncertainties do remain, and there are execution risks of Pop Mart expanding into other sectors, such as media, entertainment, and other merchandising, accessory, jewelry, like you just mentioned. And so we need a longer track record of proof to see how sustainable the success of Pop Mart will last.
Poojan, I'll bring you in on that because as Jeff is saying there, it's just, we just don't have enough of a track record yet. Hello Kitty from Sanrio is definitely one that has been around for years now, but what kind of impact does the craze around Labubu have on Sanrio?
Yes, thank you for your question. So for me, I do not really see these two IPs competing with each other. Rather, I think that we should recognize how these newer IP companies are trying to replicate what Sanrio has done in the past 50 years. And I think Sanrio's biggest strength is that it has cultivated a wide fan base across generations and different cultures through utilizing multiple channels, as what Jeff has mentioned, through merchandising and licensing and through media promotions. And I believe that we can draw some similarities in how Sanrio markets its characters as if they were like idols, and each with their own distinct personality and appearance. So fans can vote for their favorite character each year at the Sanrio character popularity ranking. And I think it takes a long time for a company to get to the point where Sanrio characters are currently. So Sanrio not only owns Hello Kitty with over 50 years of history, but they also own Maimelu, who is also going to have their 50th anniversary this year, as well as Pom Pom Purin and Cinnamoroll, who are all IPs that are over 20 years old. So I think that with the breadth and width of Sanrio's portfolio, as well as their know-how in the marketing their characters over the past few decades, I think that it's interesting to see how Pop Mart can copy the success formula of Hello Kitty and Sanrio, and I think we will see if they can become the next Hello Kitty.
Yeah, Poojan, David here. Can you talk a little bit more about that? Because that's really an interesting take, that how you increase the shelf life, literally and figuratively, of these products is through marketing. What would be, in your view, say, the top one or two successful marketing use cases that Sanrio has managed to put in place that maybe they could take and, Pop Mart, the folks at Pop Mart can look at and maybe emulate?
Yes, thank you very much. So for the most successful strategy that Sanrio has, I believe, is that their characters are very versatile. So that makes them very attractive for licensing partnerships. And if we compare the revenue structure of Sanrio and Pop Mart, we can see that Sanrio actually has royalties revenue accounting for about 40 to 50%. So that gives them a lot of operating leverage and also can grow their margins continuously. And the second thing that I think Sanrio has been doing very well is that Sanrio has been active in marketing through social media. And the Hello Kitty and Friends YouTube channel targeting English-speaking audience actually has over 4 million subscribers and 600 million views. And I think Pop Mart is also has a YouTube channel, and they're trying to grow the audience through their YouTube channel. So I think that this is showing why this formula has been successful, and I think that, yeah, that's what Pop Mart needs to do going forward.
Jeff, I'll ask you just to react to what Poojan has said there.
I feel this, if we compare Sanrio with Pop Mart, their playbook will eventually resemble each other because they're just at the different stages of development in terms of the IP business, how the companies can roll out and ramp up their royalty income over time. So Pop Mart, for its IPs, we also know that they may have finite lifespan, they may have finite shelf life. So that's why to expand it and to extend it over a longer period of time, and the expansion, the foray into the related industries such as media, entertainment, like what Poojan has mentioned for Sanrio and even for Disney, will be a natural move. So right now we're still seeing some initial progress. Like for Labubu, apparently it has high commercial value and potential to be further commercialized and monetized through different channels. But right now they're still at a very initial phase. And it still remains to be seen how successful Pop Mart can pull off this strategy over time. And I also want to highlight that execution risk does exist.
On the risk point as well, we just were speaking with Charlotte about this report this morning that there's concern maybe around sort of the model that they're taking as well. What sort of regulatory risk are you seeing, and how much are you factoring that in as well?
Yeah, so overall, we view the regulatory risk and the negative impact as moderate for Pop Mart for now. While this they may have or trigger some sell-off on Pop Mart stocks, we think overall the risk is still manageable, given that first, there have been prior regulations in China on restricting the selling of blind boxes to the underage. Like what Charlotte has mentioned, the children under 8 are banned from directly purchasing blind box in China. So with such strict regulations already being implemented, it still remains to be seen what incremental could be added on the regulatory front by the authorities. And also, I would like to point is that Pop Mart's focus has been shifting from domestic market to overseas. While overseas sales still just accounted for less than 40% of its overall revenue in 2024, we expect this figure to reach over 70% over the next decade. So in this regard, we feel that the shift of the focus of Pop Mart will make the impact from the domestic market more controllable. So overall, we view the impact as limited.
Morningstar analysts there, Jeff Zhang and Pujans Chen, and just to reiterate their ratings here, on Pop Mart, it's 2-star, that's overvalued from Jeff, and of course from Pujans there, it's a 3-star. On Sanrio, fairly valued. Okay, you might have just seen this as well for our Bloomberg clients. It might have already come out on the TV. We have a red headline coming through here. Donald Trump can keep using troops in LA for now. That's according to the appeals court. There's a broader read that you can talk about, that you can look at on your Bloomberg terminals right now, but I'll just take you through some of the top lines there. It's certainly a win for the White House currently. You have a 3-judge panel in San Francisco saying that the White House can keep using the California National Guard troops to respond to the current situation. Plenty more ahead. You're watching The China Show. There's somewhat of a reversal across these markets. Here on my right, it's now green across most of your screen, at least here specifically, all of it. We're up now 1% on the Hang Seng Index, but I believe it's still at these levels. We're still on track for a modest weekly pullback on the benchmarks themselves. But yeah, we're going, I mean, certainly the risk profile of this weekend does seem fairly elevated, of course.
Yeah, absolutely. Certainly, we're going to be watching these developments very closely in the Middle East. But closer to home as well, you've got domestic pressures in China, and young people are continuing to battle a sluggish job market, falling wages. And off the back of that, some are actually turning to fortune-telling and mysticism. Bars and cafes are seeing this, and it's also an opportunity for them to cash in and boost their businesses. Our China correspondent Min Min Lo reports that the rise of the superstition economy is also drawing scrutiny from authorities.
I'm drawing a divination stick that's supposed to predict my future, but I'm not at a Chinese temple. I'm at a bar in Beijing. These divination bars are popping up across major Chinese cities, where you can order a splash of cocktail with a side of fortune telling.
The bar business has been declining, but spiritual bars are on the rise.
The so-called metaphysics economy, including tarot card reading, astrology, zodiac prediction, energy healing, is one segment of the Chinese economy that's defied the weak consumption sentiment, seeing a 10% growth per year by some estimates. Consulting firm Daxue says economic pressure and uncertainty are driving the search for Zen as China grapples with elevated youth unemployment rates, slow wage growth, and anxiety over job security.
I started buying crystals because when I just graduated, I was confused. My mental state was not good. I felt helpless. At such a time, sometimes when you know there is no way to seek help from the outside world, you would believe in this kind of thing.
I'm walking along the stretch of a Beijing hutong that I used to frequent, and even within a 10-minute walk alone, I've noticed 6 or 7 of these shops selling crystals and amulets and fortune-telling and tarot card reading services. And these are shops that even just a few years ago weren't as commonplace as they are now.
感谢自媒体呗。 Thanks to social media, there are more and more influencers posting about tarot cards and horoscopes. It gave everyone a channel for self-exploration that gradually created the market demand.
On social media platform Xiaohongshu, the hashtag spirituality has drawn millions of views. Tencent-backed astrology app Ce recorded nearly 2.6 million monthly active users in May, a 36% growth on year, according to data analytics provider Moonfox Data. Then breakthroughs like DeepSeek turbocharged the sector's prominence.
Many of you have DeepSeek now. You love to use it. In fact, one CEO friend of mine asked his employees, what do you use it for? And good question. And the answer was fortune telling.
After the practice went viral, the censors caught up. The app now sometimes returns similar queries with the answer, I do not provide content related to superstition.
For Chinese government, they are always very cautious about anything that's related to superstition and misleading medical claims. So business, they should be really aware of the advertising restrictions, consumer protection laws, and digital platform regulations.
The Chinese internet watchdog launched a campaign in September 2023 to crack down on the spread of superstitious information online. Offline, though, that hasn't stopped consumer brands from seeking creative crossovers to tap into the spiritual demand.
I have noticed a lot of beauty collaborations. The Chinese leading brand, Proya, has collaborated with the temple in Hangzhou. They even launched a co-branded skincare box.
Like the soft toys and blind boxes that are benefiting from emotional spending, prayer beads and fortune-telling are now moving out of temples into malls and bars, putting the spiritual into sips of spirits. Min Lo, Bloomberg News, Beijing.
We're just drawing your attention to a line that's just crossed the terminal here. The IDF is saying that they've identified missiles launched from Iran toward Israel. So this is the defense force, of course, from Israel. This does follow what has been a series of attacks from Iranian missiles and drones on Israel over recent days. They had appeared to be subsiding just as early as Wednesday of this week, prompting authorities in Israel to be able to relax some safety restrictions. But again, just in the last few minutes, we've got this line saying that the IDF has identified missiles launched from Iran toward Israel as well.
And yeah, it's probably going to take a few minutes for that to be visible, if any, of course. But just a reminder before we just wrap up the show that this is a developing story. We'll pass the baton, of course, to our colleagues. It has on Insight coming up next. But yeah, we'll continue to track this, bring you more details on this as we move into, it's 11 a.m. here in Hong Kong, Singapore and Beijing, and of course in Tel Aviv. We're just waking up there, 6 a.m. local time. We'll keep on the top of the story. Oil prices are mixed. That's it from us. We'll see you all on Monday. Insight with Haslinda is coming up next.